Hey guys, Joshua here, and in today's video, I'm going to give you the 6 stocks that I believe you should buy and hold for life, or at least until retirement. I'm going to give you my full analysis on each of these stocks. We'll talk about some of the key numbers, and I'll give you my reasons for why I believe these are the best stocks to buy and hold for life, or at least a very long time. Hey, also really quick before we get into the video, if you could do me a huge favor and drop a like on the video. It takes you like 2 seconds, but it helps the channel out so much. Also subscribe if you're new. Okay, let's get started. First stock on this list is Apple, ticker symbol AAPL. So I think it should probably go without saying that this stock doesn't need like an introduction, but in case you don't know what Apple is an American technology company that designs, develops, and sells consumer electronics, computer software, and other online services. Apple really changed the world back in 2007 with the release of the first iPhone ever, which not only changed technology forever, but also changed the trajectory of Apple forever, and pretty much solidified them as the leading technology innovator in the entire world. And of course, the sort of broad consensus is that Apple still remains the leader in innovation, and I don't really think that's going to change anytime soon. Now, from a purely numbers perspective, Apple has done extremely well. They've recently become the first US company to reach a $2 trillion market cap, and they were also the first US publicly traded company to reach a $1 trillion market cap back in 2018. This means that in a little bit over 2 years, Apple has quite literally doubled their value. If you take a look at Apple's chart, you can see that they've experienced monstrous growth since 2009, when at the time their stock was only trading at around $3 per share. It's actually really easy to forget that at one point, Apple's stock was actually considered a penny stock. Penny stocks are technically stocks that trade below $5, and from 1981, the day that Apple IPO'd, all the way up until 2009, Apple was trading below $5. The massive growth that Apple has experienced is obviously thanks in part to their unprecedented innovation, right? I mean, I know they're good at marketing, but their products are still really good and serve a very specific market. However, because of this innovation, they've also managed to usher in a new era of technology that I believe will last hundreds of years. As long as they can keep innovating and staying ahead of the curve, then they'll keep growing as a company. And if they continue growing, then it would obviously benefit you to just keep holding their stock for a very long time. Apple is currently trading at around $126 per share, a number that will likely be different by the time you're watching this. Their 52-week price range is a low of $78.27 and a high of $145.09. And as I previously mentioned, Apple has a market cap of over $2 trillion, or $2.2 trillion to be exact. The current price to earnings ratio is 28.46, which means that their stock isn't considered to be too overvalued. Apple does pay out dividends, and their current dividend yield sits at almost 0.70%. Although that's not like an incredibly high dividend yield, the fast increase of their stock price is to blame for that. I personally think that Apple's dividends will outpace the appreciation of Apple's stock price over the next couple of decades, which will of course increase the dividend yield significantly. This means that holding on to this stock long term will give you increasingly higher dividend yield payments. Apple's revenue over the last 12 months was $274 billion and is up 54% in the second quarter of 2021. Stock is projected to have a high of $185 per share over the next 12 months, a median of $160 and a low of $125, meaning that analysts really believe that Apple only has upside potential. And speaking of analysts, let's take a look at how analysts rate this stock. So on a scale of 1 to 5, 5 being a sell and 1 being a strong buy, analysts rate Apple at a 2.3, which means it's a good time to buy. All technicals aside though, fundamentally speaking, Apple is a really good company that makes extraordinarily good products and services. And if they can continue to innovate in their space, then I see no reason to believe that they won't continue to grow even beyond their current space. At number 2, we've got Amazon, ticker symbol AMZN. And this may have been another obvious pick, but for good reasons. It's really no secret that Amazon is an incredibly good long-term investment. What started off as a small marketplace to buy books back in the 90s has turned into a vast universe of seemingly unlimited choices. Amazon has pushed the limits of online shopping by drastically improving shipping speeds, constantly increasing product selection, and always prioritizing customer service with things like their easy return process. However, although most people know Amazon for Amazon.com, their e-commerce store, this is not the only thing that they do. Amazon also has a massive business in global cloud computing with Amazon Web Services. In fact, Amazon Web Services currently has a market share of about 33% in the cloud computing market. Other major players in this market include Microsoft Azure and Google Cloud, but even those two combined don't have a larger market share than Amazon. Even aside from those services, Amazon still has even more, like their third-party seller services, their physical stores, their subscription services, and other things like Amazon Ads. Taking a look at Amazon's charts, you can see that their growth has been completely linear since they IPO'd back in 1998, with exponential growth starting around 2014. Amazon is currently trading at $3,259.05 per share and has a 52-week low of $2,330 and a high of $3,500 $554. Amazon's insane growth last year was primarily due to the global pandemic. Because of all the stay-at-home rules, many people just bought everything they needed online. And because Amazon holds about 40% of the US e-commerce market and likely received a boost during the pandemic, they reported significantly higher than normal profits, and of course the price of their stock just followed suit. This stock has a market cap of 1.64 trillion and a PE ratio of 62.2 and does not currently pay dividends. Amazon's revenue over the last 12 months is $386 billion, up 37.62% compared to last year. This stock has nothing but positive price projections over the next 12 months. Analysts believe that this stock will be at a high of $5,500 in the next 12 months, a median of $4,225 and a low of $3,500, which is still up nearly $300 from its current price. This stock currently has a rating of 1.7, which means it's almost a strong buy. Amazon has done extremely well expanding itself outside of its primary business. For decades now, it's been acquiring businesses from left to right, spending billions of dollars to acquire technology and customers in industries outside of e-commerce. Amazon's most notable acquisition over the years has been Whole Foods, an American multinational supermarket chain that surged in popularity because of their emphasis on organic food. You see, all these acquisitions are notably important because it shows that Amazon is making a proactive effort to avoid making the same mistakes that other retailers have made. For example, like Sears and Kmart, they failed to innovate, and so now they're pretty much out of business. And honestly, I think that because of their strategic approach to expanding and how they're always improving, that Amazon is going to be around for a very, very long time. And so that's why I think that their stock is definitely a buy and hold for life kind of stock. Coming in next at number 3 is Waste Management. I know this stock is sort of a curveball, especially compared to the last two, which were obvious buy and holds, but Waste Management is a buy and hold gem. Waste Management is the company that handles everyone's garbage. And unlike some trends which can go away after a while, garbage is one thing that definitely isn't going away anytime in the next few decades at least. And it's for this reason that I believe this company will continue to be profitable, which means it'll continue to boost investors' portfolios with both capital gains and dividends. If we take a look at the stocks chart, you can see that it's had slow and steady growth since IPOing back in the 90s. And honestly, sometimes you just need stocks like this in your portfolio. They help to balance out the volatility that you get from like growth stocks and even certain types of ETFs. The growth is steady and predictable, and for a long-term investment, this is exactly what you want. This stock is currently trading at $140.69 per share and has a 52-week low of $100.45 and a high of $144.54. It has a market cap of $59.38 billion and a PE ratio of 38.49 and a dividend yield of 1.63%, which means this is a good dividend stock, and that's always great for long-term investing. Waste Management's revenue was down 1.53% over the last year, and now that we're coming out of the pandemic, their revenue is back up 10.27% in the last quarter. This stock currently has a rating of 2.4, which means it's a buy. I also wanted to mention that Waste Management doesn't only handle garbage. They also take care of most of our recycling, and they're currently developing ways to turn landfill gas into energy that can be used to power your phone, your home, and frankly, an entire city. This means even as the world gets more and more green and we're able to start turning to more renewable ways of living, Waste Management will still be a good play for decades to come. Next up is Adobe, or more formally Adobe Systems, ticker ADBE. By market cap, Adobe is the 4th largest software company right behind Apple, Google, and Microsoft, but that's not why this stock is a buy and hold type of stock. Adobe has solidified itself as the leader in digital creative software with tools like Photoshop, After Effects, Illustrator, Lightroom, and Premiere, all of which have become industry standard tools in their respective fields. Adobe also invented the portable document format. The PDF file is a file that's accepted on virtually every machine in the world, and it's become sort of a global standard for files. Adobe stock really began taking notice around 2011 and has grown exponentially since then. This growth actually makes sense because it was exactly around that time when Adobe stopped selling physical software on CDs and repositioned themselves as a cloud-based software as a service company. Naturally, the revenues began increasing, and so the price of the stock also saw massive growth. This stock is currently trading at $505 per share and has a 52-week low of $361.44 and a high of $536.88. Adobe has a market cap of $341.43 billion, a PE ratio of 43.86, and they do not currently pay their shareholders dividends. This may change in the future, but it's not necessarily uncommon for software companies to not pay their shareholders dividends. They typically prefer to reinvest those profits back into the company to experience more growth, which of course you as a shareholder will still benefit from because of capital gains. Analysts believe that this stock will be at a high of $650 in the next 12 months, a median of $575, and a low of $511, which is still higher than the current trading price of $505. This stock currently has a rating of 1.6 1.7, which means it's almost a strong buy. Moving forward into the future, for the next few decades at least, I believe that Adobe will continue to be a leader in the software space. Not only does Adobe create some of the best software in the industry, but it also has virtually no competition. Most professionals require the robust tools offered by Adobe over sites like Canva, a graphic design platform that provides digital templates. And as companies around the world continue to improve their marketing quality and develop content for online users, Adobe is really going to be the only option that they have. And this isn't necessarily a bad thing because their software is really good. At number 5, we have Berkshire Hathaway. Their ticker symbol is BRK.B. Now, you could technically buy BRK.A, which is their Class A stock, but that's currently trading at $432,274. So I'm going to assume that most of you want BRKB, which is Berkshire's Class B stock, which is trading at a much lesser price than that. So if you're new to investing, then you likely don't know what Berkshire Hathaway is and who runs the show over there, so I'll give you a really quick breakdown. Berkshire Hathaway is a multinational conglomerate holding company led by legendary investor Warren Buffett. So Berkshire Hathaway is a holding company. This means that they don't actually produce goods and services. Instead, they're in business to buy other businesses. And this could be either buying them outright or holding very large stakes in them. For example, over 75% of Berkshire's holdings are in Apple, Bank of America, American Express, Coke, and Kraft. But besides those larger holdings, they also own several other companies outright. They include Geico, Dairy Queen, Benjamin Moore. Berkshire has experienced rapid and consistent growth since IPOing back in 1996. This stock is currently trading at $287 per share and has a 52-week low of $174.63 and a high of $295.08. It has a market cap of $657.35 billion and a PE ratio of 0. Now, Berkshire Hathaway does not pay their shareholders dividends, which is very surprising considering how much Warren Buffett loves receiving dividends himself. But nonetheless, that still doesn't change the value of this stock. Over the next 12 months, analysts believe that this stock could be at a high of $321.15, a median of $307, and a low of $277. This stock currently has a rating of 2.2, which means it's a buy. Now, the reason Berkshire Hathaway is a buy and hold forever kind of stock is because they have their hands in dozens of consumer-related industries that I believe are not going anywhere ever. For example, insurance, electricity, chocolate, paint, jewelry, ice cream, underwear, shoes, homes. These are all things that consumers are buying today and will continue buying 100 years from now. And so it's safe to assume that Berkshire Hathaway will continue to be a buy and hold forever kind of stock. And lastly, number 6 is Procter & Gamble, ticker symbol PG. Procter & Gamble, or just P&G for short, is an American multinational consumer goods corporation. They sell products in major consumer goods categories that you might be familiar with. For example, Bounty, Tide, Pampers, NyQuil, Olay, Gillette, and Dawn, just to name a few. P&G was founded back in 1837 by William Procter and James Gamble, making this company nearly 200 years old, which would explain their headquarters. The fact that they've been in business for almost 200 years is a huge testament to their longevity, but it kind of makes sense. I mean, why would they ever go out of business? People will always need toothpaste and they'll always need soap. Unless another company comes out and invents like a tube of toothpaste that never runs out or a bar of soap that never shrinks, then Procter & Gamble has pretty much guaranteed that they're going to be in business forever. Taking a quick look at P&G's charts, you can see that it has consistently grown since 1981. Now, this should come as no surprise because, as I mentioned, people were buying toothpaste and soap back in 1981, or at least I think they were, and they're still buying it today. I know I am. And so that linear growth of the stock makes sense. This stock is currently trading at $138 per share and has a 52-week low of $111.68 and a high of $146.92. It has a market cap of $338.91 billion, a PE ratio of 25.46, and a handsome 2.51% dividend yield. And Procter & Gamble is notoriously known for increasing their dividend payments year after year. Even after some companies decrease theirs during certain periods of recession, P&G continued to increase theirs. Analysts believe this stock will be at a high of $168 in the next 12 months, a median of $147.35, and a low of $130. This stock currently has a rating of 2.5, which means it's in between a buy and hold. P&G is a very boring stock, but in a world of blazing fast growth stocks like Tesla and Netflix, which are known to have really unpredictable price swings, P&G is a predictable stock that has slow and steady growth, and it pays its shareholders really good dividends. For that reason, I think this is definitely a buy and hold forever kind of stock. Now, I didn't want to make the video too long, so I left off a few stocks, but I want to go ahead and mention those now as like sort of honorable mentions. They include Microsoft, Nike, Disney, Google, and Johnson & Johnson. These are all really good buy and hold forever kind of stocks. All right, so there you have it. The 6 best buy and hold stocks that you should buy right now and hold forever, or at least until you retire. Hey, if you found some value in this video, do me a huge favor and drop a like down below. You have no idea how much it helps the video out and just my channel in general, so just really quickly drop a like. Also, subscribe to the channel if you're new and you haven't subscribed already. I would love to have you on board, and as always, I will see you again very soon. Take care.